I started investing with tiny amounts of money whilst I was still at uni. Fast forward 5.5 years and I've built an investment portfolio of over £75,000. And in this video, I want to go through my full portfolio. It's my last portfolio update of 2025, and it's going to be a big one. We'll go through every single account from my stocks and shares ISA and my self-invested personal pensions. The only things that I'm not going through are my short-term savings and my workplace pension. What I really want to show is that absolutely anyone can invest as long as they approach it with the right mindset and are willing to ride out the volatility. There's nothing special about me. I've graduated from university, I've got a mortgage, I've not inherited anything. I've just built this portfolio through consistency, not being an expert, no perfection, just being consistent. We're not going to waste any time and I'll just jump straight into it in this video. But as always, just to quickly mention, I'm not a financial advisor and this is not investment advice. I'm simply sharing my own journey. When investing, your capital is at risk and the value of investments can go down as well as up. So I'm going to start off on the Getquin app here. I use Getquin to aggregate my portfolios, track all my individual accounts in one place. And you can see here, the current portfolio value is £75,970. We go on the year-to-date chart, you can see my portfolio year-to-date is up 12.1% or £8,201. And you can see that big dip earlier in the year in April. That was when Trump did his thing with the tariffs. And you can just see how since that April dip, it has been smooth sailing upwards almost. Of course, there's volatility along the way, but it has been overall a pretty great year to be an investor. And a good as a reminder as any is that you can't time the market. You have to put up with volatility. A lot of people were panicking back in April, but being consistent and sticking with it really has paid off in this situation. Of course, who knows what is going to happen next year, but that's the thing of being a long-term investor. You shouldn't really concern yourself with what's happening tomorrow, next year, or even the year after that. It's really about where's your portfolio going to be in 5-10 years time. If you are looking for a portfolio tracker to monitor all your investments in one place, then it might be worth checking out Getquin. I'll leave my affiliate link in the description below. I do get something too if you use that link for full transparency. Okay, we're starting off with my biggest account by far. It's my Trading 212 Stocks and Shares ISA. So you can see the current value is £51,904. Rate return 34.7%, total return £7,000. So the big caveat I have to say with my stocks and shares ISAs is that I have moved providers, transferred providers a few times over my investment journey, about 3 or 4 different providers. So this total return isn't reflective of my total return since I started investing. It's my total return since I've been using Trading 212, which was April 2024 when I first started using it. And then in July 2025, I transferred one of my other ISAs over. So that's why it's all in one place now. But yeah, just had to give that caveat, otherwise I get the comments saying, why is my return so low after 5 years? So if we scroll down, you can see I split my portfolio into 3 separate pies. In this core fund, I just have a simple global tracker. You can see I have the Spider MSCI All Country World Index Tracking ETF. This just delivers the return of the global stock market. It contains about 2,300 stocks, both developed and emerging markets. There's nothing fancy about this. Just delivers the return of the global stock market. If the global stock market goes up, so does this. If the global stock market goes down, this goes down. It gives diversified exposure. And over the long term, a global market tracking ETF has delivered investors good returns. I do think it's pretty difficult to beat the market. And when I combine those two thoughts that I have, that I like diversification and I think it's difficult to beat the market, I'm happy to have a global tracker at the core of my portfolio. Then if we go to my satellite funds, so these are still funds, but I call them satellites because they're small positions around the portfolio that I use to put my own spin on things, different strategies that I like, or maybe actively managed funds. If we scroll down, you can see my largest position here is JP Morgan Global Growth and Income. This is an investment trust. It is actively managed. That is one of my sins here. I have an actively managed fund that's quite a large position. I say a sin because the track record of active managers over the long term isn't great. But I like to play around, and although maybe this is a bit oversized, I'm happy to have it as a smaller part of the portfolio. So it's called Growth and Income because it pays quarterly dividends as well as being focused on growth as well. And it is one of the few things in my portfolio that pays dividends because for the most part, I like the hands-off approach, accumulating funds that automatically reinvest dividends. Next up, we have the Avantis Global Small Cap Value. So small cap value is a type of investing that has historically delivered returns that have outperformed the market. There's no guarantees going forward, but this is an ETF that invests globally in small-sized companies with value and profitability filters. So value filter, meaning it invests in companies that are cheap relative to their fundamentals, and a profitability filter, meaning that it invests in companies that are profitable, so it avoids the junk end of the market. This is doing quite decently for me since I've held it. I think I first bought this year, so I really can't complain. Next up, the Scottish Mortgage is another actively managed investment trust. This invests in both public and private companies. So one of the benefits of an investment trust is that they can invest into private companies, and then you can invest into an investment trust that is publicly listed to get indirect exposure to the private companies they hold. So, for example, some of the largest holdings in Scottish Mortgage are SpaceX, so the big space company owned by Elon Musk, and ByteDance, which is the company that owns TikTok. So they're probably the most, the private companies you're most likely to have heard of. And I do think it's pretty cool to be able to get indirect exposure to those sort of companies. It does invest in publicly listed companies as well, some of the largest holdings being the likes of Amazon, Mercado Libre, just to name a couple. Then lastly, we have the Wisdom Tree Global Quality Growth. So this is another factor investing type ETF. The clue's in the name, Global Quality Growth. So it's a global ETF with quality and growth filters. How this turns out in practice is it's quite similar to a NASDAQ 100 ETF, just a little bit more global. And you can see here the fund allocation. Alphabet is by far the largest position, over 10%, and that's just because Alphabet has been in an incredible run recently. And then other Mag 7 companies. And the reason why this has performed so well for me is that I got very lucky with the timing of this one. 41% return, but that's because I bought it right at the bottom of the Trump dip in April in the new tax year. Completely lucky to invest right at the bottom there, and you can see it's been pretty much just flying upwards since that for me. But I do say I don't try and time the market. That is just pure luck investing at the bottom there. And then the last part of the portfolio I call the fun stock picks. Fun is in speech marks because it's only so fun underperforming the market, which is what I'm definitely doing right now. Scroll down, ASML is doing amazingly, but apart from that, it's a mixed bag. Adyen, Mercado Libre, and Bloomsbury letting the team down. But yeah, it's just a small part of my portfolio for a bit of fun to scratch that stock picking itch. Maybe I'll remove this going forward. Maybe I'll keep it up, but what I will do if I do keep it, it'll just remain a small part of the portfolio just for that bit of fun. Investing can be incredibly simple, and I would be quite happy to just get rid of all this, the satellite funds, just go all in a global fund. If I had no interest in investing and I was just doing it to build wealth, I'd be quite happy with just a global fund. But because I find investing interesting, I like trying out these different strategies and a small part for individual stocks. Right, so last thing to show here is asset allocation, more details. You can see here, unrealized results. So this is just the profit or loss on the open positions. It doesn't include realized gains or dividends that are being received. And you can see the large position by far is the global index fund with a 60% allocation, then my other funds, and then the individual stocks. Okay, on to the next account. We're now in my InvestEngine self-invested personal pension. So you can see £12,906 in here, and the total return so far is £1,506, 31.54% time-weighted rate of return. This is a good example of how it's not worth overthinking of investing and just getting the money in, because I invested, if we look at the buy and sell points here and go on the 1 year chart, we can see that I invested a lot of money, £4,000 there at one of the worst possible times, February, just before the Trump dip. And you can see that it was £10,000, then it was down to about £9,000 a month later. And that's just really poor timing, and there's not much I can do about it. Sometimes you will invest with bad timing. But just by not thinking about it, letting it ride out, you can see that has flown back up, and then we're now well in the green. So if we scroll down in the portfolio, this is a very simple portfolio. I have a global index fund, the same one that is in my stocks and shares ISA, and a US small cap fund. So US small caps really haven't been performing that well this past year. So just have a look at the 1 year chart here, only up 2% over the past year. So not too good for US small caps. So they have been a drag on the portfolio over the past year. But the global index fund has been performing quite strongly over the past year. That is up, when it loads, 12.16%. So yeah, overall, happy to just let this sit away in the background. The good thing with a SIP is that I really can just sit there and let it do its thing, because I can't access this money for 30 plus years. So I really just don't worry about it. I'm happy to be 100% in equities, ride out the volatility, and yeah, hopefully, alongside my other pensions and stocks and shares ISAs, I'll be able to retire early in 30 years' time. We'll see how things go. Okay, so now onto my last account, my Hargreaves Lansdown account, and I do have two portfolios in here, my lifetime ISA and my self-invested personal pension. Lifetime ISA, I recently used my lifetime ISA last year to buy my first home, so I emptied it for my deposit, and I opened another lifetime ISA because you can also use a lifetime ISA for retirement, and I just thought I'd open one, just put a small amount in there so it's there if I do decide I want to contribute to it later on, but it's only £100, so we're going to skip over that for now and go into the self-invested personal pension. I opened that earlier this year, only a few months ago, and the reason why I've split my self-invested personal pension across two accounts is that one, Hargreaves Lansdown had an offer where if you invested £10,000, you could get a John Lewis gift card for £200. So I thought, why not? I'll take them up on that. But also because InvestEngine don't allow limited company contributions. So I needed another SIP provider that allowed the possibility to contribute from a limited company. Hence why I went with Hargreaves Lansdown. And as you can see here, this is in the same global index fund, £10,000 in there. And that is a theme here, really. It's super simple. When it comes to my pensions, I'm not really interested in complexity because I can't access them for so long. With ISAs, I like to tweak things a bit more because I enjoy investing, as I say. But for something that for pensions, I don't really want to think about, I'm just going to keep it simple. It's what works for me. That's all my accounts. And to finish up, we're going to go back to Getquin and just get some portfolio insights. So here is my portfolio. If we go on the asset allocation tab and just click show more, you can see overall, I have over 70% of my portfolio in that global fund, the MSCI All Country World Index ETF by Spider. And this is what I wanted to aim to do. 70% in the global core and 30% to put my own spin on things. With the vast majority of that 30%, I'm keeping it super sensible and diversified. Yes, it's still funds that could potentially outperform or underperform the market, but they're still diversified. So worst case scenario, it's a fund. Although it can crash, it's not going to be a case of losing all your money when it comes to funds. Very unlikely anyway. With individual stocks, I do keep them as a tiny allocation in the portfolio just because there are increased risks with them. And I do find stock picking to be, for the most part, not worth the time. It takes a lot of research to pick stocks well. And also, controversial opinion, but I'm not convinced that even research gives you that much of an edge because when retail investors say they're doing research into stocks, I don't know. What does that really mean? Google Finance, Yahoo Finance, reading a few tweets on X. I'm not convinced that gives you a bit of an edge on large cap, mega cap stocks, but what do I know? Let me know your thoughts on stock picking. So that's my last portfolio update of 2025. I wanted to do a full run through because I have done portfolio updates recently where I've celebrated milestones and gone through lessons, but I hadn't shown every position that I have for a while. And there it is. It's just what suits me. And I just want the key messages to take away with all my videos is that investing can be as simple or as complex as you want it to be. But just be careful with complexity, that it doesn't always lead to better returns or better outcomes. And it does come with behavioral challenges. Every layer of complexity you add is another thing to doubt in your portfolio, to be tweaking with. And there's a lot of research you can look into that when it comes to tweaking and chopping and changing, it just usually leads to worse outcomes. And keeping things simple, consistently contributing, importantly, using tax-advantaged accounts, combination of ISAs and pensions in the UK. The right combination will depend on your personal circumstances, but in general, most people want to be using one or the other or both. And if you do those things, have a long-term mindset, invest, you're probably going to be able to grow your wealth. And it was great to see Martin Lewis talking about investing on his recent show. Unfortunately, in the UK, we are a nation of savers. And the problem with cash savings is that over the long term, it's unlikely to keep up with inflation and you're basically losing money in real terms. Yes, the nominal value in your savings account is going up, but the purchasing power is going down. And Martin Lewis showed that on his show that even if you use the best savings accounts, the savings accounts that he recommended, he's scanned the market to find, you'd have still underperformed inflation. That's pretty shocking, really. That if you were savvy and put all the effort switching savings accounts, you've still underperformed inflation. And it just goes to show the necessity of investing for long-term wealth building. Yes, there's risks, but let's try and translate that more into not a risk, so to say, but volatility. The risk is the volatility in the sense that you buy at the top and sell at the bottom. But if you're adopting a long-term mindset, riding out that volatility, that's when the risks are massively reduced. So just for most people, whilst I can't give advice, what I can say is generally diversification and long-term mindset. If you do those two things with investing, you're probably going to be okay. And we should also think about the risks of cash savings, that with cash, you are almost certainly going to lose money in real terms, even with savings accounts, just because it's how things work. If you aren't taking on any risk, you can't expect good returns. You need to take on at least a little bit of risk to get some decent returns. As always, let me know your thoughts in the comments below, and thank you for watching.